Hello and welcome to Introduction to Options course. This is the second lesson and we are going to speak about buying options. So, in this lesson we are going to understand what to expect when buying an option and learn the proper difference between a call and a put option. So we are going to see once again the basics of an option, how to buy a call, how to buy a put, how to buy a protective put, and of course how to execute a trade. So if you remember, we spoke about the anatomy of an option symbol, where we can see the symbol, the year, the month, the day, and the type of option together with the strike price. We saw as well the premium, which is the intrinsic value plus extrinsic value. But don't worry, I'm going to enter into this one later on in another chapter. And then we saw the type of strategy that we had. So in this case, a long call or a long pull, and a short call and a short put. So let's get on with buy a call. So we have these stocks, XW, XYZ, and if trading at $42 a share. And we believe that in the next days, weeks, months, imagine for example we are in March and we are going to believe that in April the price is going to raise. So we have a bullish expectation that this stock is going to go in the trend direction. And also we want to use the smallest possible risk as possible. For this we are going to buy one contract of XYZ on April, and we will say that it's going to finish at the price of 42.50 is going to be the strike price. And for this we are going to pay a premium of $210. In this case 2.10, but remember we always have to calculate by 100. But in this case, what does it mean? It means that you pay $210 and this is the maximum that you are going to lose. And it's giving you the possibility to play with 100 shares at $42.50 per each one. In this case, $42,500 of value. So with 0.5% of the total price of the asset, you are going to be able, to perform all of this operation. It's literally 0.5%. So now let's calculate what's going to happen. So as we said, let's imagine that the price of the strike is 42.5. So we arrive in 1st of April and now we saw that the price is 50. So in this case, we are going to calculate the value that we have at the expiration. In this case, it's going to be 7.5, the difference. And this 7.5, we will have to subtract what we paid for the premium. So in this case, the premium that we paid, it was $2.10. So the total profit that we would have in this case is going to be $5.40 per share. So in this case, we paid $210 and we are going to net $540. So almost 2.5 times the initial. So in this case, 250% return of investment for the operation that was being made. Now we have a different scenario. Let's assume that the price finished on 45, the same. Now we have the value of expiration of $2.5 because we have to rest 45 to the initial point, 42.5. And we have to rest the option cost, which is 2.10. So in this case, we would have a profit of 40 cents per share, which is going to be $40 for the initial risk of 210. We would, for example, imagine right now, if the price would go at 44.60, it would be actually our break-even cost. And then let's take different type scenarios. Let's imagine the price is going to finish at 40 or at 37, 35, it doesn't matter. The maximum that we are going to lose, it was always going to be $2.10 per share, because this is the premium that we paid. So this is the maximum and the always valued, better said, that we are going to lose if the price is going to finish below our strike price of 42.5. So yeah. Here we have a graph of all of this as well. We can see that with this type of trade, our profit is unlimited. So as long as the strike value is going to raise, our profit is going to be raising over and over again. And we can see always that the maximum amount that we are going to lose is going to be $2.10, which is going to be starting from 42.5 because it's our strike price, and everything after that it will start to be bigger and bigger, where at the end of 44.6 is going to be our break-even price, where we are going to finish on zero, and everything after that is going to be in profit. Now, as I said, if you would buy a stock on this same scenario, imagine, for example, in this case, you bought a stock. So in this case, instead of buying an option, let me open a notepad, smaller one. So let's imagine in the same scenario, instead of paying, so we pay $210, for one option contract. But now instead, let's assume that we buy actually 100 shares. Okay, so we buy them as well at 42.5. So in this case, our total investment is going to be this one. Now imagine, for example, make the same calculation. Let's assume that the price, for example, is 40. So if price of the stock is 40, now we are going to sell all of this for 100. Now it's going to be 450 minus 400. So in this case we will lose minus $150. Let's assume as well that if the price, for example, of the stock right now is 35, so in this case it's going to be 42.5 minus 35, which is going to be 7.5, but it's reverse, sorry. 35 minus 42.5, which is minus, multiplied by 100, and we are going to lose actually $750. So we can see that in this case, if you would have a stock instead of an option, if the price would decline against us, we would lose $750, which is much more than we would lose, for example, with the option. Because with the option, it's always the risk, it's limited in this type of scenario. But let's assume the different type of case. Let's put, for example, now, imagine we bought at 45. Let's assume, for example, now the price is 50. So let's say if price is going to be 50, so if in this case, we would have $50. If the price of the stock is $50 now, it would be 50 minus 4.5, so we are going to have plus $750 in the end. And in this case, you can see that if we would have the price of the 50, we would have $540 because we would have to pay the premium. But yeah, so let's put this one. But you can see that we would have $450 of profit for an initial investment of this one. This is the initial investment. While with the option, we had, for example, $540 of return, but in this case it was only for $2,010 of initial investment. So you can see that we need much lower margin with an option contract than we would need with a stock. If we would use the same value as the stock, our profit, it would be much higher. But yeah, I'm not going to enter into that. But yeah, I hope this one made sense. Let's continue. So yeah, like I said, buying a stock or versus buying a call. So we can see that the leverage with the risk limited to the premium paid. So you are always going to risk the premium, no more, no less, while with the stock is not the same. Yeah, we would have a higher break-even point. We can see that, for example, with the stock, we would be break-even on 42.5 because it's the price that we paid. But for example, with the stock, with the option, no, we will need to pay the premium. So it's going to be 42.5 plus premium. It's going to be our break even. So in this case, it's going to be 44.6 because the premium is $2.1. So yeah, and then of course we have the limited life. And with the stock, for example, imagine you believe that it's going to be bullish, but maybe in 2 months or 3 months, you can stay because you are going to have those shares and you can keep them. Nobody is going to take them and they are not going to expire. But with option, it's not like this. You are always going to be pressured by time. Now, let's make the other part of the trade. In this case, let's make a put. So, yeah. Like I said previously, it's happening the same like with the call, except now we believe that the price is going to be bearish. The market is going to be bearish instead of the call, which is bullish. So yeah, we are going to apply the same scenario, except in this case we are going to play a premium of 230 instead of 210. So yeah, let's make we can see the differences here. So we put the price at 42.5 for this put contract, and we paid for it $2.3 per share, so 230. So we can see that the break-even is going to be 42.5 minus the premium, in this case here, which is going to be 40.20. And we can see that everything after that is going to be a profit for us. And like for example with 40 or 37.5. So everything below 40.20 is going to be a profit for us. Everything above 40.20, it will be a negative for us. And the maximum losing point that we are going to have is going to be from 42.5 downwards. And we are always going to lose the maximum of 2.3, which is the premium that we have. So we can see the graph. It's exactly the same, except it's in reverse with the call. So if the price, for example, in this case, it would go negatively, well, you have the exponential value until 0, because that's the maximum that we can go. But yeah, but in the case, for example, of the call, yeah, it's infinite. But everything from 0 until 40 is going to be profit for us, and above, you know, it's going to be the premium that we paid as the risk. So yeah, to see the summary of all of this, the buying calls give you the right to buy. The buying puts is giving you the right to sell, because maybe I didn't explain here the properly. So you see, we have the put at 42.5, and right now the price is 40. So it's giving you the possibility to sell the asset at 42.5 and buy back at 40. So that's how you make the profit with sale. So we can see that we have to we can short the market with a risk limit, you know, to the premium paid, and yeah, it can help us to protect against a single position or the entire portfolio by buying puts. So a protective put, you know, in this case, it can help us to limit the downside of the risk potential of a stock that you own, and at the same time to buy a put operation of the stock. The put owner will then have the right to sell the stock at an agreed upon price, the strike price, until the expiration date. But you can also buy a put, you know, like as a protection. So if you are going to do this, the risk is going to be limited to the option premium paid and out of the money amount at the time of the trade, if there is going to be any. At the same time, it's going to provide a limited protection against the losses in case of the stock goes below the strike price. And yeah, we do not have to exercise the put since we are the holder and have the choice if we want to do it. At the same time, unlimited profit potential on the stock is going to be reduced by the cost of the put. So like I said, in this case, we believe that the market is going to go bullish. We buy 100 shares of this stock at $92, and we want, you know, we want to have the limited risk. We are going to buy one QRS April 90 put for $0.95, and we are going to pay $95. 0.95 per share, while at the same time we have 100 shares bought at $92. So in this case, it's a bit more advanced strategy, but we can see that by doing this, we are combining the put option with the stock option at the same time. So the put option is going to help us hedge against the buy of the stock. So you can see that in this case, for example, the price is going to go for 100. We would benefit $8 while we would lose the credit premium from the put. But then it's going to help us, for example, in the price goes against us. So in this case, for example, let's say the price is going to be 85. You can see that we will initially lose $7 from the shares that we have, but the put is going to protect us. So in this case, we are going to lose 2.95, which is going to be the maximum that we are going to lose downward. So we can see from this case, that it's going to protect us if we want to combine both the stock and an option into one operation. So yeah. Now, as I said, before you place a trade, you have to consider first, when you buy a call or you are going to sell a put, buy a put, is the equivalent of owning 100 shares of that stock. At the same time, you have to consider how much you are going to be able to risk and be comfortable at the same time with it. That's going to be the premium that you're going to pay. So that's going to be helpful for you when you're going to manage your risk. So yeah, long options, you are going to sell it, you are going to exercise it, or you are going to let it expire. Short option, you are going to buy it back. You are going to fulfill your obligation when it's assigned, or you can let it expire as well if it's going to be out of the money. So yeah, we have the grocery, break even, long call, protective put. So yeah, thank you for watching, and yeah, see you in the next lesson. Bye bye.